Hi, Hamish Conway here, and welcome to another episode of Tacos Tuesday. This is episode 83, and with me again today, well, not again, where have you been, Sebastian Hargraves? Good to have you back.
I've been deep in Prime Week, making sure that we get the best results for our clients.
Yeah, 100%, and we'll do a podcast on that hopefully next week. We're just waiting for all the attribution to come through, and we'll share what we found out with that. But great to have you back here, and today is going to be, it's halfway through the year, and so we're going to share with you what happened in the first half. It's hard to believe we're halfway here. We're nearly thinking about buying Christmas presents again, but there's a lot that we learnt in the first 6 months of this year. Well, particularly when we compare back to last year. Now, for those of you that might be listening in for the first time, so at Sell Global here, we deal with a lot of brands, predominantly in Australia, but also USA, Canada, UK, and those markets as well. Overall, we deal with over $11 million a month in sales that we manage. So we've got a really unique perspective about what is working. And when we aggregate our data, it can tell us patterns about what is really going on. And today we thought, right, how do we get as clear apples v apples comparison? And so we decided just to focus in on Amazon Australia in the first half of 2026 and comparing it to the first half of 2025, because as you're probably aware, with deal events, etc., at the back end of the year, it kind of moves the sales needle too much. So we want to compare exactly as much as we could. And to even narrow it down further, we've got 14 companies that we help, and that we were helping in 2025 and are helping in 2026. So we've had new clients come on board since then, obviously, but we're not going to bring that into the mix. We just want it to be exactly the same companies over exactly the same time period. So hopefully that makes sense. And that just gives us a lot more relevance, because look, for you, if you're operating a brand, and whether you're running the advertising or you've just got an interest in the channel and want to know, is our marketing spend there making a difference? You've only got one account that you're looking at, so you don't know what, if there's things aren't working, you might not know really why. And so today, I think you're going to be fascinated by what we've discovered and around the competitive nature of Amazon Australia, how it's moved in the last year and what impact that's had on click costs. So we're going to share with you what we've noticed there. Is there still organic growth in Amazon Australia, or is it having to rely on paid? And we'll share the key levers that we've used to make some changes. And look, we made a conscious decision to have a strategic shift to look at overall growth. So as an agency, our focus is on how can we help brands grow their overall sales. We don't just focus on their advertising sales, and we don't just try and make their ad spend, their ad ROAS look amazing. We focus on what do we need to do to grow overall sales. And so one of the key shifts we made was to move more of the focus onto category search terms rather than just focusing on branded search terms. And when we go through this today, you'll see the impact that has had, and we'll give you those results. And also, we've got a report on this that I'll give you this detail at the end as well, but you can email hello@gosellglobal.com and we'll send you this report. And as we go through this today, Seb's going to be doing most of the commentary, because this is what he put together, and he's been the man, being the head of advertising at Sell Global. So Seb, is there anything I missed in that intro that you want to share in terms of what people are going to get from tuning in today?
No, I think you covered it all. So yeah,
Great.
This is just going to be able to help you guys benchmark, to give you guys an understanding of what's working in your own account.
Yeah. Okay. Brilliant. So look, let's start high level. Do you want to give us the story of the first half and maybe some of the headline numbers?
Yeah, sure. So obviously, as Hamish said, we're just comparing these 14 specific brands, just so that the data is nice and clean for a comparison. So the headlines are that total sales was up, and as Hamish mentioned, we're focusing on the incrementality of what ads and focusing on the incrementality on Amazon in general. So total sales were up by 32.5%, up to 33.7 million from this half of the year to the last half of the year. A good chunk of that was driven by ads, but the majority was actually driven by the organic side. And you guys may have heard us talk about this before, or you should have definitely heard us talk about this before, but ads' primary job is to continue to grow and expand, the organic side of the business, because that's how you can keep your margins healthy while growing at the same time. Some other pieces that also came out of comparing this year to last year was that the auction got pricier. So cost per click rose almost 60%, which is a huge increase. And part of that's because of the strategy piece that Hamish mentioned at the start. Cost per clicks are going to be more expensive on the unbranded side of the equation. But part of that is absolutely because it is getting more competitive out there. So we'll talk today a little bit about, what do you do in an ever increasing competitive environment? Because as you can imagine, you can't keep lifting your CPCs by 60% every year. There just wouldn't be enough room to continue that path. So
no, okay. And so just to drill in on that though, for people listening to understand how so the first part there is, yes, the costs have gone up, and part of that could be because of the strategy moving away from as much branded, because branded is cheaper. The cost per click is cheaper when you go for the category. To win in the category, you've got to bid more. But there's some other factors there that we knew that this was competition bidding up the same clicks. So what were those factors?
Yeah, so I mean, some of it is the fact that the CPCs rose on all sides of the equation. So we knew that even on the unbranded side that the CPCs rose on that side. So that gives us a really good indication that that market share piece that we're going after, there others are also going after it as well. So cost per click, I think we've got it in here. It went from 90 cents up to $1.43. And so that's a decent increase there. But the other piece was ad impressions across the portfolio grew by 26%, and our click-through rate sort of held flat. So that extra cost was competition bidding up the same clicks, not weaker ads. And we know that because of that click-through rate on our ads.
Yeah. And so, so the job there isn't to avoid those rising costs, but it's like, how do you out execute it? So interesting. All right. So there's a big question here and around organic. You were saying before that our philosophy is around how do we use ads to grow organic? And look, we know Amazon Australia has been growing anyway. On the 1P side, last year in 2025, it grew 20%. Overall, it was estimated to be near 28% when you add in the 3P side as well. So we know there's growth there. But what did we notice around the organic growth and the strategy that we applied to win more of that?
Yeah, so when we very first looked at it just from a pure percentage point of view, we could see that ad sales were, growing at a far greater or faster rate than organic. And that is the sign of, one, strategy change like we've spoken about already, but two, this is the exact pattern that you would expect as a marketplace gets more mature. And Amazon definitely isn't they're serving up more ad placements, not less.
Yeah.
And so ads are always going to become more and more of the overall picture, which is why it's super important to have those tailored plans on how are we going to manage this rising cost of it. So, but some of the numbers, organic sales grew by 26.8%, which ad sales grew by much more than that. But when we look at the raw numbers, it went from 19.2 million to 24.4 million, and it still makes up 72% of all of the revenue. So organic is still very much alive and well. When you looked at the percentage growth, you'd be like, okay, well, organic only grew by 26%, and I think we'll talk about it later, but ads grew by a lot more than that.
It's like 50%, but the ad spend did increase though. So that's maybe something we'll talk about later.
Yeah, exactly. But yeah, from pure overall numbers point of view, it's still doing really well. So, and the reason that's important is when that starts diminishing, or when those percentages, or when that ad sales as a percentage of our total sales starts to get much closer, that's giving us an indication that there's less opportunity to grow the organic. Basically, we've captured all of the organic traffic that we're probably going to capture up until this point. And there's other ways to grow that, obviously launching new products, etc. But as it kind of stands at the current portfolio, that's what that means. And so it's a really important number for us to be across.
Yeah. Okay. So as it stands, the flywheel still turns. That paid, the strategy of paid velocity, paid sales, grows the velocity, wins the ranking, reviews, and organic sales follow. That's far from exhausted.
Absolutely. Yeah.
Yeah. Great. Okay. So given these increased competition, so you go, okay, how do we manage this? We're wanting to grow category search, not as much branded search, because so every dollar that we spend, we want to be maximizing that. What's the number one lever that we used to make a shift?
Yeah, so we'll talk about the levers we're going to talk about now will be on platform, but there's one I'll add at the end, which is talking about how do we create demand as well. So
Yeah,
these first pieces is going to be just about like, okay, we're just capturing demand on platform. How do we do that part? So lever one is our placement precision. So for anyone who doesn't know, to make advertising even more interesting, you have your bid, but then you also have what they call placement modifiers, and placement modifiers come in three forms. I'll keep it to the three forms because it's the simplest way, but there's top of search, rest of search, and product pages. So top of search is, as it sounds, the top of the page and the top of the search results. Product pages is, as it sounds, it's targeting competitor product pages or your own product pages, and it's serving ads on the physical landing page, the actual product page itself.
Yes.
And then rest of search is basically anything below the fold. So whatever you don't see on that first snippet at top of search, everything below that is what we call rest of search. So one of the key levers we did over this period is basically right-sizing our investment across those different placements. So making sure we had the adequate amount of spend for top of search, the adequate amount of spend for rest of search, and the adequate amount of spend for product pages.
Okay, how did that shift?
Because of top of search being such a better conversion rate, I should say, our share of spend went from 56% to 61% for top of search.
Okay.
It actually went down from 18% to 17% for rest of search. And it also went down from product pages, which was 26% down to 22%. So basically, rest of search and product pages got less of a priority, and top of search got more of a priority through our share of spend over that period.
Okay, and why did we put more to top of search?
Because the conversion rates are so much stronger there, and the revenue per click that we can generate is so much higher. And what we mean by revenue per click is out of every click we make, how much revenue do we make out of that? And keeping in mind here, we're talking about the unbranded side of things. So conversion rates in this example were over this period were 27.5% for top of search, 16.6% for rest of search, and 12.4% for product pages.
Yeah.
So you can see there's a significant difference in conversion rates. And so part of the reason that you see that CPC increasing is because we allocated more of our spend towards that top of search placement because the conversion rate could afford it.
Yeah, so the conversion rate is higher for top of search, but the click cost is higher as well. And for rest of search and product pages, the click cost is lower, but the conversion rate is lower. So that's right. Those kind of factor out such that the ROAS on those, even though the conversion rate is lower for product pages, the ROAS was the same as top of the search.
Yeah, so that's how you know that you've got a very well optimized account. If your ROAS is very even across all of your placements, you know that you're paying the appropriate amount of it. And so our ROAS, for example, for top of search and product pages was only a few points different. 5.95 for top of search and product pages was 5.92. So rest of search was a little bit lower than that, but pretty close to the other two as well. And so that's how you get a pretty good indication of how well. And this is a great exercise for brands to do, which is go and tally up all of your placement data and see what your ROAS is across those placement and how much as a percentage of your spend you spend across those, or get us to do it for you. So that will give you a really good indication on right sizing your spend. And in an ever increasing expensive environment, it's super critical.
Yeah. Excellent. Okay. So some people listening to this now, depends on what they are currently doing on Amazon, or maybe even when they compare to Meta or even Google. So they might be hearing a ROAS of 5.95 and going, oh, that's not that good. Let's kind of lever two, because lever one was the placements. So we've got that. Now lever two, let's talk to me about that in terms of how we view ROAS for real growth.
Yeah, for on the ROAS question, if you do look at the blended ROAS, it's going to be much higher. So it's going to be more like 13, 14 in these examples.
Yeah.
But ROAS is, like we've spoken about, not the greatest metric for measuring true incrementality. So you can have an amazing ROAS and be adding absolutely zero value in regards to revenue to the business.
And so, you could even be going backwards in market share.
Right.
Yeah.
Exactly. Yeah. You could be allocating your budget to where you think the highest ROAS and best return is, but in reality, you are cannibalizing your sales and likely losing market share where it matters. So lever two for us was trading ROAS for real growth. And so that's what we did. We moved our budgets away from just defending the brand, which defending the brand is important. And particularly, this is not a one size fits all. Yeah. Certain brands benefit much more for protecting their brand than others. I give a good example of a brand like Gatorade and Powerade. Very, very similar brands. They look similar. Their packaging is similar. In that instance, brand defense is very important. But that's because of how similar and synonymous those two brands are to each other.
Yeah.
But in any case, in this example, we moved away from that, and that's where and how we were able to generate that high good growth that you saw across the brands at the start when we mentioned that is moving that strategy.
Okay, so I'm not sure whether you mentioned there, but so our ROAS in the first half of 2025 was 7.7, and it went down to 5.8 by design. Yep. So and this is the moving away from as much branded search to more category search, because that's where we see the growth. And even if we were to look at our actual branded search, so you talk about branded ROAS, that was 17.3x. So, that's way bigger. And this is where if you're trying to make the numbers look good, you just pile in on branded search and you can make your ROAS look good. And this is a mistake we so often see in accounts, is this mistake. And so hopefully, maybe, I know it's a little bit technical here, but hopefully you're starting to see that actually finding the right balance there between branded and non-branded is required, because as non-branded is where you get the actual revenue growth, and also the making sure you're winning that market share. So tell us a bit more about that side of things. See if I haven't explained it correctly.
No, you've covered it pretty good. The branded piece, for anyone that's wondering what that means, it's just meaning if someone's searching on Amazon with a branded term. So if someone's searching on Amazon for Powerade, or they're searching in the search results and they search Powerade, that's what we call a branded search, because the search term that they used contains the brand name. And so... Yeah. So branded search is super important. I don't want to make it sound like branded search isn't important. It's actually critical. But protecting the brand name with the on platform, like with your own ads on platform, is less important for most brands, not for all brands. So our position was last year 16% of our spend was on branded. This year 11% of our spend is on branded. So we're continuing to march it down there, and 89% of our spend is on the non-branded side. So that kind of 10% mark is about where we want to sit, and probably a good benchmark for most brands, even lower for some brands depending on what available budget you have, because that is a consideration as well.
Yeah. Okay. Cool. So we talk about this term incrementality. So do you want to maybe just define that again and and what is the math around incrementality for us in the, as we look at the first half of the year?
Yeah, so there's kind of two sides to the incrementality piece. The first is the branded versus unbranded, which we've kind of spoken out at length. So it's driving sales that we wouldn't have got anyway, and we're using ads to acquire those sales. And so that's one piece of incrementality. The second piece, which we touched on at the start, is using ads to drive organic. So instead of just we pay this amount and we get this amount as an ad sale, that also might impact an organic sale and get us an additional organic sale. So we spend this much and we get an ad sale, and we also get an organic sale. So instead of it being 10 minus 5 or whatever, it's those two together that's giving us that extra incremental piece. So kind of two layers there.
Makes sense. Mm-hmm.
So yeah, some of the numbers that we had was an additional extra ad spend of 810,000, but we drove an extra 8.27 million in total sales. Now, not all of those 8.27 million in ad sales was driven by that 810,000 in extra ad spend.
Yeah.
By deploying it specifically on unbranded and driving the organic side of that equation, a good amount of that was driven. So 3.12 million of it was ad sales, and then the unknown is the how much organic that was benefited from the ads as well. But we know that it does benefit the organic side.
Right. And then just talk to me for a moment here about revenue per click. So as click costs have gone up, revenue per click is a key metric for us. Can you explain a bit about that and how you view it?
Yeah, so one side of the equation is cost per click, which is how much it cost. The other side of that equation is revenue per click. How much did we get out of each click? By having that math, you've got a dollar value. You're comparing a dollar value to a dollar value.
Yeah.
A cost per click versus a revenue per click. And so that helps us understand, yes, we know that the costs are rising by the fact that the cost per click is going up, but are we extracting more value out of the clicks as well? And if we know that we're extracting more value out of the clicks, it gives us an indication that our strategies is working.
Yeah. And so I was kind of doing some math in my head, like if the average click cost went from 90 to $1.40, that's 50 cents. But our revenue per click went from $6.91 to $8.24, which is like $1.33. So
Yes.
in effect, that increase in costs is probably lines up with a gross profit margin or a little bit better. So it kind of that revenue per click pretty much offsets that increase in cost per click. So that, which is how we view it. Yeah,
exactly.
Okay.
And that's why the percentages are deceiving. The CPCs are, but what it does tell you though is that the gap between the two of them is closing. So we've been in this honeymoon period where no competition, it's been easy as, and revenue per click's been, super high. Now we're still growing that and it's still improving. If we'd done this same thing on accounts that we didn't manage, it would be a bit different story. But we're still driving more of that revenue. But the gap is tightening. Between the two. So
interesting, right? And I think, like, if even just a bit of a little bit of a summary now, we've still got a little bit more to cover off. But I think what I'm really hearing here is if you're looking at your advertising performance and wondering why is it not doing as well, it's because of this. There is more competition, and what it means is your strategy has to be really on point to grow. Otherwise, you're just at risk of paying more for less, and you don't want that. And so the other, like we've talked about those kind of that lever there of trading ROAS for real growth, and so hopefully people are starting to understand that as well. But what about some other levers that made brands effective?
Yeah, so I'll touch on one other one and then I'll get into the other levers. So the third lever that I said that I'd come back to was, at the moment we're talking all about on platform and we're talking all about capturing growth. The other lever is expanding, like Hamish said at the start, our branded ROAS is 17.3. It's amazing. It does incredibly well. It converts amazingly well. It's really good. So the more of that traffic that you can have, the bigger the moat is for your business, because you can offset your costs to go after these maybe higher volume, but higher cost sort of targets. And so the way to do that is to start building above the line or top of funnel advertising. So
with a DSP or demand side platform from Amazon.
Yeah, so that's I mean, there's multiple ways that you can do it. Socials, you can be using TikTok, but yes, DSP is a super effective way, and one where it's not very competitive as well. We talked about search being not very competitive. Well, that's changing. So then it's now being DSP is the next kind of frontier where competition is still relatively low to adoption, and that's where you can start to create that branded search that performs really well. So you're not just capturing bottom of funnel customers, you're also capturing top of funnel customers who are not really aware of your brand yet, and you're bringing them into the funnel and then connecting the piece together. So, yeah.
That's good. So, yeah, for example, above the line or upper funnel with your brand, imagine this here. So you might pay for that click there, but then when they're on the platform and they see a branded ad as well, because often people are clicking on more than one ad before they buy, then you've captured them at that on the high ROAS type of campaigns as well. So that's good. Okay. And we've talked about AMC, Amazon Marketing Cloud, and understanding the customer journey. That there gives you a whole lot more insight as well. But that's kind of another level to play at, which is, we'll be sharing more of that as we go. In fact, we've got an Amazon Marketing Cloud masterclass online class we're going to be doing on, I think it's August the 13th, in fact. So keep an eye out for that as well. It's going to be amazing, and we'll dive into all of that detail as well. Anyway, so talk to me, Seb, about some other levers that made brands effective through this first half of 2026.
Yeah, so some of them are related to the retail readiness of the product. So think about things like stock and catalog readiness.
Yes.
Obviously, advertising is just one component. Stock and catalog readiness is critical. It underpins advertising. You can't have good advertising if you don't have good stock and catalog readiness. The organic flywheel we talked about. The revenue per click based bidding. So this is right sizing your bidding. So that kind of ties into what we've spoken about a little bit there. Waste elimination, so getting rid of stuff that you just really know, like maybe it's on the fringe of what's relevant to your products, but it's not the core group, and you might be able to redistribute that spend in a better above the line advertising, for example, to maximize that piece. So those are some others that will help brands as well.
Yeah. Okay. All right. So as we kind of get near the end here, look, so how do you know you're on the right track?
Yeah, so I think you're on the right track if your organic engine is working, which means that your organic growth is, your organic sales are growing. And it doesn't necessarily need to be that your organic sales are growing as a percentage faster than your ad sales. It just needs to be that they're growing, the volume of them is growing.
In real terms.
In real terms, yeah.
Mm-hmm.
Yeah.
Okay.
The other is that, a little bit around that revenue per click we just touched on. So per click cost will rise in a hot market, and that's fine. What matters is that each extra dollar of spend still returns profitable incremental sales. So you want to be focusing on that piece. And then the value per clicking is rising, which I touched here on at the end, which is rising CPCs are only a problem if revenue per click doesn't keep up. So I know in percentage terms, it looks like that's not the case, but as Hamish pointed out, revenue per click actually outperformed CPC from a total point of view. But if CPCs continue to grow at that rate, you'll see compression between the revenue that you're getting for every click and the cost that it's getting you to do that. So and then the ultimate metric at the end of all of this is your TACOS, or your total advertising cost of sale, which is the reason we called this podcast TACOS, is because it's a super important metric, because it literally tells you that relationship between spend, organic sales, and total sales, and it brings all of that picture together to understand how much more expensive is it getting for you.
Yeah. Okay. Very good. So for you, Seb, in summary, 3 big lessons from the first half.
Yep. So I think, one thing we were worried about was organic not maybe diminishing as it became more competitive. We feel like that's not true, and there's still room for organic, and organic is still the engine. Precision in this next phase, and I think we talked about this, probably 3 or 4 months ago, but precision's going to beat force in the next phase of advertising. And then measuring against margin, not the average, is kind of the third piece, that making good decisions requires you to understand the data and understand what's impacting that. Using averages like a ROAS across a whole account with a blended branded versus unbranded is going to make you make decisions that are incorrect.
Yeah, exactly. Amazing. And so look, if you're listening to this here, and some of this here may make sense or some of it may not, if you at least get the way that we kind of view Amazon ads, and in particular Seb, and the way he thinks through it. And if you'd like Seb to have a look at your Amazon ads performance, whether it's, well, sponsored advertising or even looking at the bigger picture with Amazon Marketing Cloud, then you can understand like very quickly. And when it's your own numbers, it makes more sense, right? That all the examples that we're giving here all come together when you know that you're looking at your data. And what Seb is amazing at is finding where is the low-hanging fruit and getting this precision into your advertising strategy. So if you'd like to have a conversation with Seb about what an Amazon ads review would look like, then you can connect with us either at hello@gosellglobal.com or go to the website gosellglobal.com and you can book a call from there, look under services and advertising management and book a time there. So look, thanks Seb for putting that together, and it's really encouraging to see that growth. And for the second half of the year, obviously Prime Day was the key kickstart for Australia. Also, there was Prime in other countries late June. So we will do a Prime Day breakdown, and we'll see how that compared to last year's Prime. And was it a softer Prime Day, which it may have been? And a whole bunch of other things that I know Seb and I were talking about yesterday, but the data hadn't quite come through, and it's going to take a few days to put it together. But again, we'll give you a lot of value there, and hopefully this has been useful so you can kind of benchmark where you sit. And if you've got any questions there, again, please let us know. All right, and if you did want to see this report here as well that we've been kind of talking to, then let us know at hello@gosellglobal.com. Appreciate you tuning in. Thanks so much, and please share this episode if it will resonate with someone else. Okay, thanks very much, and thanks, Seb. Appreciate it. All the best.
Thanks, guys.